Hi guys, it's the 1st of September, so it's time for our monthly market update. So let's begin by looking at the US markets and let's start with the S&P 500. Now again, as I always say, that we can't predict the future. We can't predict where the price is going to go in the short term. All we can do is to identify where is the market right now. Is it on an uptrend? Is it on a downtrend? Is it in a consolidation pattern? Is it waving up or is it waving down? Why? Because when we know where the market is now, we know the current trend, we can see what's the probability of prices moving in that direction. So again, when the market is on an uptrend, the probability is that prices will move higher until there's a reversal in the trend. Now, when will that trend reverse? No one knows. No one can predict that, right? So again, we can't predict the future, but we're looking at trends and wave patterns to just look at what is more likely to happen. But there are no guarantees in short-term price movements. Now, having said that, let's take a look at the S&P 500. So, as of the beginning of the year to now, year to date, on the daily candles, you can see we continue to be on a very, very nice uptrend. In fact, this year, you can see the uptrend has been very, very smooth. It doesn't happen every year. In some years, it's really choppy, but this year, the uptrend has been very smooth, and you can see that the corrections have been very, very consistent. That since the beginning of the year, we have made 1, 2, 3, 4, 5, 6, 7 corrections. And each time it made a correction, the market has been down roughly between like 4 to 5%. 4 to 5%. Very, very consistent. And every time it corrected, you can see it found support at the 50 moving average, the blue line, right? It touched and it went up, touched and it went up, right? So again, you don't always get this smooth uptrend, but this year has been really, really smooth. And it's really interesting because if you look at the chat group for the year, you can see that every time the market goes into this correction, people freak out. Oh my God, the market's going down. Why is it going down? We're gonna die. Oh my God. Right? You can see every time it goes down, people freak out. But remember that that's how the market behaves. The price can't go up every day, every week, every month. It will go through wave downs ever so often. So expect it is part of the market, right? It's kind of like, I remember when I sat on a plane once, turbulence is part of a plane. You can't have a plane without turbulence. And there was this big guy sitting next to me, and when we went through turbulence, he looked at me and he held my hand and he wouldn't let go, right? I was like, hey dude, chill out, right? Flying's like that, right? So it's the same thing with the market, you will have this. So where are we right now? Right now, you can see that we just went through a wave down, and right now we are on a wave up, okay? So how long will this wave up last? Again, who knows, right? We can't predict, but eventually it will wave down again. Now, you may have heard that September and October, in terms of seasonality, they tend to be bearish months, where the market tends to go down in September and October. Now, does it happen all the time? Of course not. If you look at the last 100 years, September and October tends to go down like maybe 56% of the time. So, do I pay any attention to this as an investor, as a trader? No, not at all. I just look at it as an interesting statistic, but it plays no significance in my decision-making process. Why? Because sure, it happens more than half the time, but you never know which year it will happen, all right? And if you want to predict the market and say, okay, it's going down in September and October, I'm going to sell now, and what if it doesn't go down? What if it keeps going up? Then you miss out on those gains, right? So, forget predicting the market, right? But again, I'm not surprised that we will have another 1 or 2 more corrections before the end of the year, because again, we are on this wave up pattern. And again, after wave up, you got to have a wave down, right? So it's again part of it. Now, again, as long as we remain on this uptrend, then the path of least resistance is upwards and onwards. As long as we remain on the uptrend, the market will continue to go higher until there's a change in trend, which we can never know when, but when it happens, then we will know it happens when it happens, all right? So the question is that during the next correction, where are we likely to find support at? Again, so far this year, the 50 moving average has been a very strong support. Okay, very strong support. So if it drops and corrects, then my first level of support would be, there you have it, right? The 50 moving average right here. Dung dung, there we go, okay? So from the high now down to the 50 moving average, that represents roughly about a 4% correction, which is very healthy. So remember that on an uptrend, on a bull market, corrections are healthy. In fact, corrections between 5 to 15% are very healthy and very normal. Just like a plane, turbulence is healthy and normal. Of course, if the correction goes more than 20%, then technically we're in a bear market, all right? But I don't see that coming anytime soon, because a bear market again happens like once every 5 to 6 years. So don't see that happening, at least for this year, all right? Now again, could it correct even lower than the 50 moving average? Yeah, possible, right? So if it breaks below this 50 moving average, where's the next support level? Well, then you take a look at a bigger time frame. We look at the weekly candles. Let's look at the weekly candles, 5-year weekly candles, right? And you can see that on the weekly time frame, the price looks pretty far from the moving averages. Remember, moving average eventually will come back, or the price rather will come back to the moving average, right? And you can see that on the weekly candles, when it corrects, it usually comes down to at least the 20 EMA, the red dotted line, right? And we have actually not touched the 20 EMA for quite a while. For quite a few months, we have not even hit the 20 EMA. So again, I'm not surprised that, at least before the end of the year, we should, or not we should, but we may touch that red dotted line, the 20 EMA, all right? So I'm going to draw another support line at the 20 EMA to say, hey, we could touch that if we go through a slightly bigger correction. So from the high to the 20 EMA, which is 4,003, that's roughly about a 6% correction, right? Roughly about a 6% correction. Okay, which is again very healthy. So don't freak out. Right? A lot of people freak, oh my God. Relax. Okay, and of course it could even correct to the 40 EMA, right? It could correct even to the 40 EMA, and at a 40 EMA, that would be roughly about a 10% correction, which again is very healthy, okay, in a bull market. And then if it goes lower, it could even hit that 50 moving average, and that would be like a 13% correction, okay? Now, if you look at the monthly candles, again, take a longer view, you can see it looks even more overstretched right now, right? That, hey, eventually it's going to come down to hit that 20 EMA, but no one knows when. No one knows when that bigger correction is going to be, right? You can see historically it will come to that one of these days. So the reason I'm telling you this is so you're psychologically prepared that it will happen. Not a question of if, question of when, right? Could be this year, could be next year. So when it happens, please don't freak out. Don't, oh my God, Adam, why? It's going to happen, all right? But again, instead of freaking out, take advantage of it to add more shares of your favorite companies you've been looking to buy. Like some of you have been saying, Google's not coming down, it keeps going up. It will come down one day. I don't know when, but it will. So relax, okay? I'm waiting to buy more as well, okay? So if it drops on the monthly time frame, you can see that it should touch at least the 20 EMA, right? The red dotted line here, because it should at least come down to that level in a bigger correction. Now, from the top down to 3740, that is about an 18% correction, which again, I think when that happens, a lot of people are going to freak out. Oh my God, we're going to die. But again, it's healthy. Okay, so now, like I said, year to date, we are up about 20% year to date. Now, is that normal? No, it's not. Okay, if you look at the last 50 years, on average, the S&P gains about 10% a year. That's the average, okay? So some years it's higher, some years it's lower, but it averages to 10%. So this year, we are double the long-term average. Now remember, what the market gives, the market will take back one day, right? So that's why it eventually averages to 10%. So don't think it's going to happen every year we're up 20%, okay? But again, as investors, our job is to beat the market, is to pick solid companies so that in the long run, when the market averages 10%, we get 20, 25%. The market gives us 20%, we get 30, 40%. That's our job as investors. So I thought I'll show you this interesting chart to show you the statistics of returns in the market. And if you have taken the Wealth Academy program or the value momentum investing course, you would have seen this because it's what I teach in the course, right? So a quick revision for some of you, and for some of you who have not taken the course yet, go take the course, right? Because this is something that I do cover, which is a lot of statistical analysis. Okay, so this is based on 91 years of history, okay, since 1928. And you can see how often does the market go up 20 to 30%, right? You can see 20 to 30% gain. It happens 23% of the time over the last 91 years. So it happened in years like 2019, 2017, 2009. So these were the years where the market had a 20 to 30% gain, which is the market that we're in this year. So expect this year to be part of this statistic, right? So how often does the market go up 30 to 40%? Not that often, 12% of the time, all right? But it does happen, right? And how often does the market go up by 40 to 50% in a year, right? It happens 2% of the time. And it's usually followed by a huge crash. Usually after a big crash, and the market will go up like 40 to 50% in the next year to make up for that crash, right? And 50 to 60% of the time, or rather, the market goes up 50 to 60%, 2% of the time. And the market goes up 10 to 20%, 18% of the time. And market goes up 0 to 10%, 19% of the time, all right? So everything on the right are times when the market gained for a calendar year. So are there times when the market drops during a calendar year? Yes, it happens, but notice that it's not that often, but it happens here, right? And there are not many years it happens. Now, the majority of the time when the market does go down, it drops 0 to 10%. And that happens 13% of the time. How often does the market drop 10 to 20%? Not that often, only 3% of the time in the last 91 years, right? 20 to 30%, another 3%. 30 to 40% drop, 2%. 40 to 50% drop, only 1%. And that happened in 1931, right? So a lot of people are always so fearful of this crash that's going to happen. That every year the media says, we're going to crash, the market's going to collapse, oh my God. It's as rare as getting hit by lightning. It will happen once every 90 to 100 years, but it's pretty rare, all right? So people are so worried about this that they do not dare to invest and they miss out on this. That's really stupid, right? So remember, play the odds, right? Always stay invested because you never know which year is going to be up 50%. You never know which year is going to be down. You don't know. So as long as you stay invested over the long run, guess what? You're going to make a lot more on these years and lose a lot less on these years. And these are not really losses because they just go down temporarily, right? In fact, it gives you a chance to buy more shares at a cheaper price and they'll come back pretty fast. And then you will always make money in the end if you buy good companies. So again, we expect the bull market to continue, and I don't see any signs of a bear market or recession anywhere in the near future. If you take a look at the US Treasury yield curve, you can see that yields have remained relatively low. Usually what happens is that when there's very high inflation, yields tend to rise, right, in anticipation of higher interest rates. But you can see that the yield, the 10-year yield, remains relatively low at 1.29%. And of course, the Federal Reserve is keeping the short-term rates again near zero, all right? So the yield curve still looks very, very nice, right? Upward sloping yield curve. And the yield curve, basically when the short-term rates are lower and the long-term rates are higher, you get this upward sloping yield curve, which is very healthy for the economy, or rather it reflects a very healthy economy. Okay. If you look at the spread on the Treasury yield, which means if you take the 10-year yield minus the 1-year yield, right? So if you take this 1.29 minus this, you get a positive, right? So you can see that the spread is positive, which again is a sign of a very healthy economy. When you get the 1 year, right, bigger than the 10-year, right? So in other words, the long-term yields are lower and the short-term yields are higher. That is when the spread on the Treasury yields go below zero. All right, and that's when the yield curve inverts. And that's when we have a sign that the economy is in trouble. And that's usually been a predictor of the last 7 recessions. And again, we are nowhere near there. We are nowhere near this zero line. We are way above that, right? And the Treasury curve is again very, very healthy. Now, again, like I said, it's not a perfect predictor of the bear market, but it's interesting to look at, all right? I also like to look at the earnings yield on the S&P versus the yield on the 10-year Treasury, right? Why? Because you must always compare which is more attractive. Are stocks more attractive or bonds more attractive? As long as stocks are more attractive, money will keep flowing into stocks as compared to bonds, right? And what makes the stocks more attractive? Their earnings yield is higher than the yield you get on the 10-year Treasury or the 10-year bonds. So as of now, you can see that the S&P 500, the earnings yield is 2.9%. In case some of you don't know, earnings yield is actually the inverse of PE ratio. Right? So, PE ratio is the price divided by the earnings. If you invert it, it is earnings divided by price, right? Which tells you that for every $1 of the share price, how much do you earn in terms of profits? This gives us the yield on the S&P 500, all right? And right now the yield is 2.9%, which essentially means that for every $1 you pay in terms of the share price, you're getting 2.9% of profits, all right? And if you compare that to bonds, it looks more attractive because bonds only yield 1.3%, which is the 10-year government bond, which means for every $1 you pay, you only get 1.3 cents back, okay? Which is not attractive, right? So as long as the blue line, the S&P earnings yield remains above the green line, stocks are more attractive to bonds. Stocks are relatively cheap versus bonds, even though the S&P looks high based on the PE ratio. Now, what's been really interesting is that if you have been following the news, okay, for entertainment purposes, of course, I keep saying don't read the news to make decisions on the news, but you can read it for entertainment, right? But don't ever let it influence your decision making, all right? So what has been happening is you guys may know that Michael Burry, who was famous for shorting the housing market in 2009, made billions of dollars. He was featured on the movie The Big Short, which I highly recommend you watch the movie. It's a fantastic movie. So this guy is a famed short seller, highly respected person. And he's one extreme, okay? Because what Michael Burry is saying is that he expects hyperinflation. He thinks inflation is not going to go down. It's going to go up and it's going to be really high. And the Fed will have no choice but to increase interest rates more than expected. And when that happens, right, his prediction is that a lot of the highly valued tech companies will collapse. So he has shorted the ARK Innovation ETF run by Cathie Wood. Why? Because if you look at the ARK ETF, is made up of companies that are all losing money and they are all overpriced. And he's saying that when interest rates rise, the day of reckoning will come when companies that are not making money, that are driven up by speculation, will all collapse. So he's short ARK ETF, $31 million short on that. He's also short Tesla, 731 million short, because his thesis is that, again, Tesla is way overpriced. It should drop by 50%, which I do agree with him that Tesla is like 100% overpriced, right? So he's bearish on emerging technologies, and he's also bearish on bonds because he thinks that bonds are overpriced, which I also agree, okay? So that's one extreme case. Now, the other extreme is Cathie Wood, who runs ARK ETF, and obviously she's pretty pissed off because he is shorting her ETF, right? And he is shorting Tesla, which is her favorite company. Now, she's taking the opposite spectrum, and she's saying that no. Not only will there not be hyperinflation, but she's saying that we're going to have deflation. Yeah. And she's come up with some theory to explain why, right? Which sounds, well, a bit weird, right? So she's saying things like because commodity prices are falling and technology is deflationary, which I agree with. If you watch my YouTube video on inflation, I do explain that technology is deflationary. So I think that technology is deflationary, but it will not cause deflation. It will just prevent hyperinflation. Okay, so she remains very bullish on her emerging technologies companies, right? So she's remains very bullish on Tesla, on NIO, on all these speculative high-flying tech stocks. So two spectrums. Now our job as investors is not to predict who's going to be right, because who cares and who knows. Our job as investors is to have a solid, diversified portfolio such that whoever is right, we will make money. We will make money, right? So on one hand, if we do see a spike in interest rates, by the way, interest rates are definitely going up. It's a question of when, not a question of if. They will go up. The question is, will they go up faster than expected? No one knows, right? But if they do go up, we want to benefit. How? By ensuring our portfolio has companies that benefit from rising interest rates. For example, banks. So you know that I'm holding a big chunk of Singapore banks. You can hold US banks as well, but I prefer Singapore banks right now because they are paying a very high 4% dividend yield versus US banks where the yield's only 1 or 2%. And Singapore banks are a lot more undervalued compared to US banks. So by holding the Singapore banks, not only do I get the 4% dividend yield, but it's a hedge against sudden spikes in interest rates, because with interest rates spiking, the financial bank stocks will do really well. All right. I also, as you guys know, have Ping An Insurance, which is an insurance company, and insurance companies generally benefit from rising interest rates as well. I also have got CME Group that will also benefit from rising interest rates. All right. Now, at the same time, if there is also high inflation, I don't expect hyperinflation, but I definitely expect inflation to rise and remain at maybe 3% or even 4%. So with high inflation, which companies will do well? As long as you own companies with pricing power, which means the company is able to raise their prices to make up for their increase in business costs, they are hedged against inflation. So these are companies that have got a sustainable competitive advantage. So when a company has got an economic moat, which are the companies in the UIP, they are able to raise prices. So Nike can raise prices. McDonald's can raise prices. These are great companies that can raise prices and they can pass on the additional cost to consumers, and hence they are hedged against inflation. All right. Now, on the other hand, if we have got lower inflation and interest rates don't rise that fast, we also benefit. Why? Because we're holding a lot of technology companies. But the difference is we're not holding tech companies that are not making money, that are way overpriced, but we're holding technology companies that are making money consistently, positive cash flow, fairly priced. Again, like our ServiceNow, our Viva, our our Amazon, our Facebook, our Microsoft. And those companies will do well in either scenarios, right? So the purpose of me telling you this is that you don't have to pick a side. You don't have to make a prediction of who's right, who's wrong. Just watch it for entertainment with your popcorn, because we are building a portfolio that will be resilient, that will benefit under any market condition. Finally, let's take a look at the China markets. So the China markets have been really underperforming this year. Why? Not because of a recession, but because of the Chinese government regulation. So in a sense, it's kind of like self-inflicted wounds, which to me is good. Why? Because if it was a normal recession, it'll take quite a long time to reverse what's happened, right? But if it's a regulatory thing and it's more emotional sentiment and it's more self-inflicted, the moment that passes, the markets will come roaring back really fast. So if you look at the Hang Seng Index, the Hang Seng Index actually technically has gone into a bear market. Remember, from the top, if it drops more than 20%, it's in a bear market. And you can see that for this year, the Hang Seng Index actually dropped 22% from its high. So officially it's in a bear market. But unlike most bear markets that last 6 months to a year to 2 years, I think this bear market will be as short as the US bear market last year, which was like 4 weeks. Now, again, this is just my guess. I could be wrong, right? Why? Because again, it is an artificial bear market caused by this regulation that has created irrational fear. And once that fear subsides, I think this will reverse just as fast. So I wouldn't be too concerned about the fact that it's in a bear market, right? So if you take a look at the Hang Seng Index, you can see, again, ever since we had that government crackdown freaking people out, the market dropped 22%. But you can see that, there's a bit of a trend line support over here, all right? And we have seen a bounce over the last few days. Let's see if that bounce can follow through. This is on the weekly candles. Now, if you take a look at the longer time frame, look at the monthly candles. Oh, by the way, the Hang Seng Index is down about 5% year to date. Okay, year to date. From the start of the year to where we are right now, down about 5%. Now, if you look at the longer time frame, you can see the trend a lot clearer, right? So this on the monthly candles. And you can see that there has been a pretty strong support here, here, and here, right? Very strong support at these moving averages. This is the 150 moving average. So right now we are here and we are at this 100 moving average on monthly candles. So we'll see if we can actually get a bounce back up by the end of the year. So again, no one knows how fast this would rebound, but it will rebound. The only question is it by the end of this year or by next year? I'm hoping by the end of this year. Then you'll make my performance of my portfolio look good, right? Because one of my portfolios is pretty heavy on China, and because of the China sell-off, it has dragged down the performance of that portfolio. All right, so I'm hoping that if it can bounce back by the end of the year, then it's going to make me look good, purely for ego reasons, right? But in the long run, it doesn't really matter, okay? Now, the Shanghai index, oh, by the way, I had to highlight this, right? So as you guys know, a lot of people are looking at Cathie Wood because she's this superstar fund manager. And what happened was on the 27th of July, people freaked out in the US because Cathie said, I'm dumping all the Chinese stocks, I'm out, I'm done, right? She sold her Alibaba, JD, she's totally out. And then about 2 weeks later, or was it? A month later, this was 27 July, and on the 25th of August, about a month later, she said, I changed my mind. I'm buying again, right? So the point in showing this to you is that don't be influenced by what these people are doing, right? Whether they are fund managers or analysts, don't be influenced by them, all right? Because imagine people who read this and freaked out, they would have sold their Chinese stocks at the bottom, because the 27th of July was the bottom of many of these stocks, right? And after they saw the bottom and then it went up, and then she says, I'm buying again, a lot of people would not want to jump in because now they're paying a higher price than what they sold. And then they're out of the market, and when the stock runs to heaven, they're left behind and they'll curse and swear. So never be affected by these people, all right? Always invest based on your own fundamental and technical rules, okay? And that's what I do. The Shanghai index, all right? By the way, looking at the price to earnings, you can see that the Hang Seng, the price to earnings is at 14 times, which is below the historical average. So it's really undervalued. I've been saying this for quite long. But again, remember, undervalued can remain undervalued for a while. Could become more undervalued. But the fact is that over the long run, when you buy the market, when it's below its historical valuation, you can't go wrong, right? You will do really well over time. But you got to be patient, right? Won't come back tomorrow. Or may not come back tomorrow. May come back the next day, or the next week, or the next month, or the next year, okay? Now, the Shanghai index has been relatively resilient. Why? Because if you notice, the Chinese cracking down on these companies are all listed on the Hong Kong exchange. And the ones listed on the Shanghai and Shenzhen exchange, not really that affected, okay? But still the sentiment has caused the mainland market to consolidate, but it's still up for the year, right? So Shanghai is still up 2% year to date. It has been consolidating over here, right? And we should see a pop higher by the end of the year, right? So we have got exposure to the mainland China shares via the ASHR ETF that tracks the 300 biggest companies on mainland China. So there you go. That's our monthly market update. Hope it's been useful, and I'll see you guys in the next couple of videos. May the markets be with you. And if you've got any questions, let's discuss it in the Telegram chat groups.